Hello, welcome to taxation class, and this is the sixth module. We'll be discussing on company income tax, and we will look into the overview and scope of the Company Income Tax Act. We look at the determination of assessable profits, the allowable and disallowable deductions. We'll also look at the basis period for assessments and capital allowances, and we will finally look into procedures for filing returns and payments of company income tax. And company income tax is a foundational component of Nigerian corporate tax system and a major source of government revenue. And company income tax, also known as corporate tax, is a direct tax levied on the profits earned by companies and other legal entities, and it applies to the profit of companies operating within Nigeria, ensuring that corporate entities contribute equitably to national development. And it's actually governed primarily by the Company Income Tax Act, and it plays a pivotal role in regulating business conduct, promoting accountability, and fostering economic growth. Looking at the scope, who is liable in this company income tax? And we talk about the companies incorporated in Nigeria, and secondly, the foreign companies operating through a permanent establishment in Nigeria. And the taxable income or is the profits from all sources accruing in, derived from, or brought into Nigeria. And it includes trading profits, investment income, and incidental gains. And for the administration, it is actually collected by the Federal Inland Revenue Services and service. And the key feature is that it's actually a direct proportional tax and typically a flat rate on profits. The starting point of this is we understanding the accounting profits and the assessable profits. And when we talk about the accounting profits, this is the net profit or loss from the company's audited financial statements, and it is prepared under the IFRS, the National Financial Reporting Standard, and we have the GAAP under the GAAP too. And this is the starting point for tax computation. And when we look at the assessable profit, this is the profit figure calculated according to the company, the CETA rule, and it is the profits upon which the tax is actually calculated. And the formula to do this is assessable profit equals to accounting profit plus disallowable expenses minus allowable deductions or relief. And why do we have to do this? Not all accounting expenses are tax deductible, and not all income is taxable. That's why we need to actually do this. And when we talk about allowable deductions, this is actually the wholly and exclusively, it applies the wholly and exclusively rule. And expenses is allowable as a deduction if it is incurred wholly, exclusively, necessarily, and reasonably in the production of taxable income. And common example is the cost of goods sold, the salary and wages, the rent and utility expenses for business premises, interest on business loans, bad debt, and repairs and maintenance. Another is the contribution to approved pension schemes. We have the disallowable deductions, and this is actually what you can't claim, and they are expenses that are added back to the accounting profits, calculate the assessable profits. And for this, we have examples like this depreciation, and we have fines and penalties, entertainment expenses, personal expenses, political donations, and general provisions like for bad debt and not specific. And looking at the tax relief for assets, which is the capital allowance, these are statutory deductions that replace accounting depreciation for tax purposes. And the purpose of this is to provide tax relief for the wear and tear of capital assets used in business. And the types of allowances include the initial allowance and the annual allowance. For the initial allowance, it's actually a percentage granted in the year the asset is first used. And the annual allowance is that which is granted in subsequent years over the asset's useful life. And we have the qualifying assets, which is plants and machineries, equipment, industrial buildings. We have timing, which is the basis period, and this is actually the timing of the taxation, and this is specific period of time for which profits are being assessed to tax. And we have the standard rule, which is the basis period is the complaint accounting year that ends in the year of assessment. For example, a company with a December 31st year and will have its profits for the year ended 31st December 2024 assessed in the year of assessment 2025. And it is important to note that the importance of basis period is that it ensures each period's profits are taxed correctly and prevent overlap or omission. We have the computation, just a brief computation, and when we talk about accounting period, complaint XYZ actually has an accounting profit of 10 million, and the disallowable expenses are stated there. We have a depreciation for 500,000, entertainment 200,000, fine for 100,000, and we have a capital allowance for 1 million. And to calculate this, we said, after the accounting profit, you need to add back the disallowable, the depreciation, entertainment, and fines in this regard, which is 800,000 accumulated. And we now have the adjusted profit, which is the addition of accounting profit plus the disallowable, which is 10.8 million. And then you have to deduct the capital allowance, which is claimable, and the capital allowance of 1 million, and we have the accessible profit of 9.8 million. And in doing this, looking at to calculate the tax payable, we apply the CIT rule, rate, and which is the 30%, as per CITA, and subject to change by Finance Act. And for this, we also have for the likes of the small companies with turnover of less than 25 million, and they may actually enjoy a lower rate, maybe, for example, with 0% tax as per some Finance Act might actually bring. And to calculate the tax liability now for the XYZ company, which has an accessible profit of 9.8 million, then the CIT at 30% will actually give us 2.9 for 2,040,000. And this is the final company income tax payable for the year that was being assessed. And in terms of filing return and payment procedure, for filing annual returns, there is going to submit an audited accounts, tax computation, and completed CIT form to the FIRS, and the deadline is within 6 months after the end of the company's financial year. And the payment of tax, the deadline, it actually must be paid in full within 3 months of company's year end. And as per installments, companies are often required to pay advance tax in monthly or quarterly installment based on the previous year assessment. And consequences of non-payment is penalty for late filing and interest on late payment of tax. In conclusion, CIT is governed by the Company Income Tax Act and administered by the FIRS. An assessable profit is derived from accounting profit by adding back disallowable expenses and deducting capital allowance. And the core principle for deducting an expenses is the wholly, exclusively, and necessarily rule. And capital allowance are the tax deductible equivalent of accounting depreciation, and the basis period links a company's accounting year to the tax year of assessment. And lastly, strict deadline exists for filing returns, which is 6 months, and payment, which is 3 months. Thank you.